Good morning. We've got our eye on Pharma Niaga today. Kenanga researchers keeping its underperformed call on the stock and cutting its target price from 3 ringgit 15 to 2 ringgit 50. The counter closed at 3 ringgit 40 yesterday. Now, Pharma Niaga announced its latest results earlier this week, swinging back into the black in FY20 with earnings of 27.5 million ringgit. But that wasn't enough. Its core PATAMI of 27.5 million ringgit was weak, coming in at just half of both Kenanga and consensus estimates due to lower than expected concession demand. As for its outlook, Pharma Niaga, you may recall, aimed to deal with Sinovac Life Sciences for the purchase and distribution of COVID-19 vaccine. But Kenanga says it is unclear at this stage as to the financial impact of such a venture, considering the government will likely want to see it delivered in the most price-competitive manner possible. The research house also pointed out that the profit before tax margin for the logistics and distribution segment is razor thin, averaging at 0.2% over the past 20 quarters. Meanwhile, the recent run-up in its share price has rendered current valuations unattractive and seems to have overpriced the positive near-term prospects. Additionally, Kenanga believes the stock lacks earnings visibility beyond the interim extended concession period from the 1st of December 2019 to the 31st of December this year for the procurement of drugs. Remember, the aim is to ensure no disruption in the supply and disruption of medicines nationwide while the government conducts an open tender and appoints a new concessionaire. The research house cut its FY21 net profit by 20%, taking into account lower contribution from the concession business. According to Bloomberg data, there are 2 buys, 1 hold and 1 sell on the stock, with Kenanga the most bearish on Pharma Niaga. The average target price is 4 ringgit 28, implying a potential upside of 26% to the stock's last close of 3 ringgit 40.